Good afternoon, everyone. My name is Brian Overby. I'm the Senior Options Strategist at Options Play. Welcome to Core Options Strategies. This will be a fairly basic event that we're going to outline some strategies that are really core to a stock portfolio. And in these times with the volatility, there's no better time to have a webinar that will cover these topics than today, than where the marketplace is at right now. We have obviously a lot of volatility in the marketplace. The VIX, the volatility index, is elevated because of concerns. The marketplace keeps getting blindsided with news. We run up, we run down. Now we're back to where we started. Now, what are some option strategies that can help you sleep well at night? And that's what we're going to cover today in our presentation. It's going to be about 1 hour long. Feel free to load up questions inside the Q&A box. I'll try to address a lot of them during the show. I'm going to go through a fairly quick PowerPoint presentation, and then we'll run over to the Options Play software, and we'll try to address any questions that you may have, and even try to come up with some strategies if you have a particular stock that you would like me to look at in general. Consider that you would have this inside your account, probably have at least 100 shares of it. All right. So Options Play, empowering education all the way across the globe, actually, trying to do as much as we can to inform the public investor how to use options to grow their portfolio and sleep well at night, once again. So we're going to be showing some actual securities. They're not meant to be recommendations. And then this goes right along with first trade. If you are going to trade options, you do want to get a copy of the characteristics and risks of standardized options. This has been sent to you previously if you've signed up for option trading, but you can also just go to the website the Options Clearing Corporation website and get a copy of the characteristics and risks of option trading, or ask your broker for one. All right. Our goal today, we're going to look at income, risk reduction, tactical trading around stocks that you might be considering selling. Well, we're in earnings season, so there's also another little tidbit that we're adding to our position. But if we look at what are core option strategies, why do I want to learn them? How can I enhance my portfolio of stocks? That's the question that we're going to really try to address. So we want to look at income generation. These are the strategies that we're most interested in. And I also want to talk about how options are priced. Why are they priced? Why does it matter that the VIX index today is trading at 24 ahead of the Fed meeting, by the way, that we're going to have a little, right after this event, there's going to be a little conversation that the Fed is going to have with a bunch of reporters in a room. And we're going to learn a lot about what their outlook is for the economy and what that does to option prices. So we're going to talk a little bit about that. And then risk management. How can we reduce the volatility in general of your portfolio? And we'll look at some tactical trades and downsides and upsides. We'll look at everything as far as one stock is concerned and discuss what type of strategy you might want to do. All right, so here's the 4 basic positions of options. I show this on almost every basic option webinar. This is probably my go-to slide, but here's what we need to know. If you are buying a call option, you have the right to buy the underlying stock. You pay a price that we call the premium. Once you bought that call option, you are considered long that option in your account. Calls are straightforward. You buy a call, you have a right to buy the stock. It's going to be at a specified price. It's going to have an expiration date. It's going to be for a specific period of time. But if I'm buying a call, I have the right to buy the stock. I want the stock to go up. The seller of the call is where the term call comes from. If I sell a call, well, then I get premium. And for that premium, I take on an obligation to sell the underlying stock at that specified price for a limited period of time. And I'm considered short in my account once I am the seller. Another term for the seller in the options trading world is the writer. And I'll get into a little bit where that term comes from, but Well, I guess I'll go there now. The biggest thing is that it really comes from the insurance world, and that's where option pricing really has been developed. And you'll see a lot of synergies. And I'm going to do a scenario. I'm going to talk about a scenario when we talk a little bit about option pricing and why options are trading at high valuations right now. And it has everything to do with the concept that options were originally known as insurance products. But so the main focus is on the seller, and that hence the term call. It means that you can call stock away from the seller of the option contract. And that's where put comes from too, because if you look at the sell side of the put, well, you take on an obligation to buy. So you get premium. For that premium, you take on an obligation, and that allows somebody to put stock to you. And so you're still considered the seller, you're still considered short, you're going to be referenced, you could be referenced as the writer of the option contract. But on the buy side, as far as puts are concerned, I've been doing this for 20 plus years now, and people still really struggle when they ask questions about puts. Because you buy a put, that means you're looking to sell the stock. Buy means sell. So I buy with the intention of selling the stock at a later date. We want the market to go down. So it's an alternative to selling stock short, if you will, can be used as protection if you own 100 shares of stock, and that's what we're going to focus on today. But it allows you to put stock to somebody, and that somebody would be the seller of the option contract. You guys can see the screen, right? No? Okay. Wrong screen. Thank you, Justin. 1 second. And so when we go through, here's the slide that I was just talking about. You have the buyer, the right, the seller takes on the obligation. On the put side of the things, the seller is the obligation to buy or have stock put to it. And with the put, we're talking about buying that put and having a right to put stock to somebody. And I just want to make sure everybody's now seeing everything right here, correct? Justin, let me know if you can see the screen. Appreciate it. And here's what we're going to look at. As far as a stock portfolio is concerned, we're going to talk about consistent income, understanding strategies and best practices to add yield, especially in a marketplace where, over the markets in general have been pretty flat as far as yield is concerned, as far as upside potential on the underlying stock. We actually went way down, everybody panicked, market came back up. And since quote unquote Liberation Day, when the tariffs were announced, the market actually went all the way down and came all the way back up. And at the beginning of May, we're about right back where we started at. And thank you, Justin. And with that said, this is that, understanding the best practices to doing these type of trades is a very important thing to grasp inside that portfolio of stocks. Very much so, across the board. All right, so reduce portfolio volatility. We can do that by dampening with higher income streams. So if we're bringing in premium above and beyond any dividends the stock might pay, that can definitely help out as far as the dampening of the volatility and the risks that are involved inside your stock portfolio. And then lastly, you have the trade-offs. Understand the primary trade-off with income generation strategies inside a portfolio of stocks. All right. So Income generation, the foundation and most actively used in our portfolio. There's systematic strategies that we can put together. We've done a presentation on the wheel where we've actually sold a call and then to try to get rid of a stock. And then once the stock sells, you sell a put to try to buy it again. So if we're going through that income generation type strategy, you should generate at least 2 to 3 times the income compared to the current dividend yield of your portfolio. So we're trying to go above and beyond any dividends. And automations will help you keep on track. So we're looking to do this on a consistent basis every 30 to 45 days out, depending on the underlying stock, and trying to bring in that income above and beyond. So what type of strategies can we use to do that? Well, the first strategy I want to look at is the covered call. Now, this is probably the most used strategy in the option trading world by retail clients. Somebody owns 100 shares of stock. You have to own 100 shares because most option contracts will represent 100 shares of stock. Could be on an ETF. That's another way to try to reduce some volatility, is to actually trade ETFs that track sectors and different areas of the marketplace. But if you look at doing them on stocks, you'll have a little bit more volatility, but you also get paid for that volatility, which we're going to talk about here shortly. So in this instance, if you buy the stock outright, you have unlimited upside. If this is a profit and loss graph, you have unlimited upside because you own the stock, or you bought it as your break even, but you have substantial loss. If we sell a call, we move our break even down on the x-axis, which is a good thing, but we give up some upside potential. So that can be an issue, and you got to be prepared to sell the stock. A lot of covered call sellers always want the option to expire worthless, and that's not really the core to the strategy. If we're doing this, we don't mind if it gets assigned. If we want to adjust it, if we want to try to avoid it, we can. But then we still own the stock, so the loss comes from the stock. On the option contract, it's just opportunity, but we do get a small pillow to land on in this scenario. If the market actually does go down, we do get that premium to offset some of the downside risks. Oops. So the other alternative are put options. And now in this marketplace, I added this slide because I want to talk a little bit about how a put option can be used to protect your portfolio and also generate some income. And this goes hand in hand with what I mentioned earlier, the insurance scenario. Option pricing actually is very similar to pricing an insurance product, like on your car option, for example. If you are buying your car insurance, the car that you're buying it on, that matters. The value of the car. Are you willing to take a deductible? That will work into the price. The time, is it a 6-month policy or a 1-year policy? But most people probably have car insurance out there if you're trading options. And there are a lot of synergies between the two. So I want to talk about those. And that gives you a little bit of insight into why options are priced the way that they are today when there's nervousness in the marketplace. So when you're looking at an insurance contract, right? So let's just talk about a car insurance policy. It's going to cost you more to insure a Bentley than it is a Ford Focus, right? The value of the asset is going to cost more if you're going to insure it. That's also true in the options trading world. A $100 stock is going to cost you more to insure than a $10 stock. Why? $100 stock could go to zero. $10 stock can only go down 10 points to get to zero. Can't go beyond zero. So the price of the asset matters. The deductible. We're going to look at a 95 strike put option. We're going to say the stock is at 100. We're going to look at a 95 strike put option. That'd give us a $5 deductible going from 100 down to 95. On your car insurance, a lot of people will do the $500 deductible. If you do the $0 deductible, well, it gets pricey. And that also is true in the options trading world. Time is money, as mom always said. If we're looking at a 6-month policy, it's going to cost more than a 1 year, or cost less than a 1 year policy. Now, carry costs are an interesting thing that you don't really think of in an insurance contract, but when you pay for your insurance, you pay for it before the policy starts, you pay for it up front. So over the life of the policy, when you're getting the benefits of the policy, the insurance company actually can earn interest on the monies that you paid up front. And if they get a really good interest rate, the concept is that they'll give you a discount on your next 6-month policy. That's what the true concept of insurance is, but that's not really the case anymore in this marketplace. That goes right into their pockets. But that's the concept. They get your money up front. You don't pay for it at the end of the term. And over that life, they can earn interest on your monies while they're fulfilling their obligation if you were to run your car into a tree. Lastly, you have level of risk, right? And this is where actuaries come in, and actuarial tables and a lot of the same type of math processes actuaries use to price insurance. Is the person 40 years old, a father of 5, drives a caravan, or are they 24 years old, just got out of the Navy SEALs program, might drive their Mustang off the cliff just as a training exercise? There's a difference in profile between those two different profiles, and they try to evaluate that level of risk. And if they do, then they come back and they assign a premium. They say, here's your insurance premium. And some people value this risk differently than others, and because of that, you have different prices from different insurance companies. Hence the options trading world. Let's talk about the pure insurance. Call options can act as insurance too, but I don't really want to focus on that today. Let's just focus about the put, because I want to talk about protective puts inside your portfolio. Stock's at 100, looking at a 30-day strike, you buy a 95 strike put. Okay, $100 stock, fairly expensive. Option contracts are going to be fairly expensive. Not as expensive as a $200 stock, but a $100 stock is fairly pricey. We're going to buy the 95 strike. That means we're buying the $5 deductible. We have risk from 100 on ABC, a fictitious stock, down to 95. 5 points of risk on 100 shares of stock. That means that we have $500 worth of risk. If we bought the most at the money option contract, we would have to pay up for that, but we could buy the 100 strike put, but that would obviously cost us more. And if you look at it that way, we would be buying the 0 deductible insurance on our 100 shares of stock. Many different expiration dates. In this day and age, it's getting very confusing to know how many of them, but we got weeklies, we got monthlies, we got quarterlies. If you look at some of the indexes and ETFs, we got daily expirations. So this has changed quite a bit throughout the years, the length of the option contracts. But then you have interest rates and dividends. Now, stocks will pay a dividend, and that's going to be factored in, because when a stock pays a dividend, the actual stock goes down by the amount of the dividend, right? Well, that's going to help puts because it went down, and it's going to hurt calls. So that actually gets figured in. And on top of it, if you think of your car insurance, if you drive your Ford F-150 around for a quarter, Ford doesn't say, thanks for driving our truck, here's some money, right? But if you do buy Ford stock, you can get a dividend. And it's pretty straightforward the way all of this works. Also, interest rates, when do you pay for your option contract? You pay for it before you own it, right? At the beginning of the expiration date, not at the end. And because of that, that also gets worked in. The person that sells you the contract can earn interest on your money. And then we get the volatility. We call it implied volatility when we're talking about an option, because we're talking about what the marketplace is implying the volatility to be going forward. Now, if you put this all into a pricing calculator, like the Black-Scholes pricing model, one of the original pricing models ever written, you actually come up with a price, and we call that the premium in the options world. Now, how is volatility figured, and why is where the VIX is at right now such a talked about subject? It's because the more volatile the underlying, the pricier the option contract is going to be. So it equates to risk. What are the highs and lows day in and day out of the stock price? What are the swings in the stock? The more volatile the underlying is, the more premium you're going to have to pay to try to protect it because of those wild swings. Now, the VIX index, the volatility index put out by the Chicago Board Option Exchange, or the CBOE, why do people call that the fear index? Why do people care when volatility is up? That means that people are nervous. When people are nervous, they like to buy puts. They like to protect their positions. They might be buying them because they think the market's going to go down and they don't own the stock. They're just buying a put to speculate on the price. But a lot of people, especially in the indexes, are buying puts to try to hedge their portfolio or protect their portfolio. And the more buyers that come to the marketplace, the more the market makers charge them for those puts, which equates into implied volatility, meaning you're paying more for those option contracts than you did previously. So when the VIX index in general, which is based off of options in the S&P 500 index, starts increasing, that usually is a hint that people are buying more put options in the VIX index, and the perception is that they're probably buying it to protect their portfolio. All right. So do we have any questions on just option pricing and option trading at this point in time? And if we don't, we'll move on. All right. So there's passive risk management. You could have active risk reduction, and in my mind, you're managing your risk, and you have to kind of understand some of the trade-offs in the marketplace, because if you have a forecast or an outlook for an underlying stock, there's a way that you can look at your options to try to come up with a plan to try to protect your portfolio and look at your risk overall. So passive and active management, if we're looking at the covered call strategy, I would call that active, in that if you're selling calls on your stocks over and over again, you're actively looking at your portfolio. Now, if you aren't doing it on a monthly basis or a bi-weekly basis, you can call that a passive management strategy. And I'm going to share with you actually a trade that I've done, that I've kind of reintroduced and I've done in my own portfolio actually, to try to protect some of the stocks. It's an alternative to a covered call, and I'm going to share that with you today before we're all done. Now, active strategies are costly in that at First Trade, we don't have a lot of commissions, but commissions are an issue, and they can weigh in on a lot of your costs. Technical analysis can be utilized to try to improve market timing and improve this passive way or even active way of trading. All right, so here's a portfolio hedge. Now, this stock is a fairly expensive stock that we're looking at, and we're going to talk about look at the volatility in the stock. So I'd say this is a fairly volatile stock by looking at the actual movements. The highs and lows over the certain periods are fairly wild, right? Even though the stock went nowhere in this period, I mean, it went down, back up, which is probably in this situation a 30-day period. Even though that is the case, we really the stock was just really volatile within the period. Not a lot happened as far as the price is concerned, but it's volatile. So because of that, it's going to be fairly expensive. So we're going to look at a scenario going up, going down, and wanting to protect our trade. The trades that we're going to focus on is a protective put, also known as a married put. And we're going to look at a collar too to go along with it. So we bought the stock at $520. $520 is where the stock is at. If we're buying a put option and we want to look at protection going out about 30 days in this instance, with the $1,000 deductible put option, as I talked about with the pricing, from $520 down to $510 is trading for $12.50. So $12.50 is what you'd have to pay to buy that protection and protect yourself on down from 510 all the way down. So if we look at that, we're talking about $12.50 divided by 520 is about 2.4%. So that's what it's going to cost on my $52,000 worth of stock to protect myself from $510 all the way down. So that's not a bad price when you think about it. We're going over a 30-day period, and I'll talk a little bit about that period going forward. But we also have a deductible. So you got to add another $10 onto that. So with that scenario, you're about going to double. You're going to look at about 5% of the portfolio in order to protect your stock. So if I think of this, and I'm looking at this trade, do you, and I'm looking at this trade, do you, is 5% worth it to protect your portfolio? Now, if you look at the stock and you look at the movement, even from the recent high to the recent low, the answer is yes. And if I do this trade, am I bearish on the stock? What's my outlook? And let me think of this. Let me explain it this way. If you buy your car insurance, are you hoping you run your car into the tree before the end of the term? No, in general, most people don't, but that's called insurance fraud, by the way, if you do that. But there are a few people, bad apples out there that might consider doing it. But most of the people, no, they don't want to use that insurance. And your best case scenario here is if you put this on and 30 days goes by, that the stock is up $12 and you're break even on the upside or it goes above and beyond because you own the stock and you have more upside potential from the stock than you do from owning the put option. So in this scenario, if I'm doing this trade, I got to ask myself, is 5%, is that what I'm worth paying? And then also if I'm doing this type of strategy too, I'm not looking to do it over and over again. I'm not going to do it every single 30 days because 5% is a lot to try to overcome to try to get some upside. Stocks don't have a tendency to go straight up. If they do, well, then this is a great trade because you just keep making more than what you paid for the put on the upside. But usually you do it in times like now, around an earnings quarter, you're nervous. Around the fact that we don't really have any clarity as to what's going to happen in a trade war that we have going on right now. So I might want to just buy some protection over the next 30 days to see how it plays out. I can do it on my portfolio or I could do it on an individual stock. And we'll talk a little bit more about the portfolio if I wanted to do that. And we can reduce our costs then. So we're looking at 2.5% on the downside to protect this position. But what if we sell a call? We can sell in this scenario the 540 call on the upside, and so we get a little bit more upside than we do on upside potential, and we're going to receive $12.10. That almost pays for the put. But if we do that, we cap our upside on the underlying stock. But now the insurance isn't affordable. I'm saying I will give up some upside on my stock. I still got upside from 520 up to 540. But by doing that, I'm going to reduce the cost of my put. My put is almost free. I'm going to pay 40 cents for it. I give up some upside and I get the downside. Now, if you do this, this is called a collar. This is taking the protected put, combining it with the covered call, and collaring your stock position. Now, if the stock goes up and it gets called away at 540, hopefully you were okay with selling the stock at 540. If not, you would have to do some protective measures to try to avoid being assigned on that call option. So if you have never done covered call writing, well, this is a little bit of a scary strategy unless you really want to sell the stock, unless you feel like you have some upside and you're okay if the stock moves all the way up. Now, if it's somewhere in between, if it lands at, let's say, 530, well, nothing really happened, right? I still own the stock. I still got the upside on the stock. The put and the call kind of offset each other. 30 days goes away, and you basically are down 40 cents from your caller. And you still own the stock, and it kept you in the position, and you didn't panic and get out on the trade. All right, so that's a solid scenario, but now we still have one more scenario that we can look at. What if you want to buy the stock? And one other way to do this is thinking about dollar cost averaging. And if I am an active trader, I don't, and just in general, if I'm going to even take a large position in a stock, I don't, let's say I'm going to buy multiple hundreds of shares. Instead of just 100 shares, we're going to buy 200 or 300 shares. Let's say 300 just to make life simple. Well, I like the concept that you buy the stock, maybe you sell a call against it, and you say, if the market is down, and this technically is where we're at, right at the 480 level, this is an area of resistance on the downside on this chart, and we bring in $2.50 for just saying that we would buy an additional 100 shares of this stock at a lower price. I sell the call, I bring in the $12, I sell the put, I get $2.50. Now we're talking about almost $15, $14.60 of dollars, and that's real money, right? Now you're talking about a real percentage and a real premium that you're bringing in inside your portfolio of stocks where you don't mind buying another 100 shares. So very important here. First of all, you got to be approved through First Trade in order to do these trades. So you got to get that level of approval if I do this. But if I'm doing this, the way that we always talk about it is you're cash secured. If you were looking to buy 300 shares and you got 100 shares in your account, well, you would assume that you have that money to buy the extra 100 shares. And that would be the goal. But you wouldn't be buying it at 520. You would need $48,000 in this instance to be able to buy that extra 100 shares at 480. You're going to get 250, and if you've sold the call, you're going to get to 1250. So you're going to end up with $1,460. It's going to help you offset the cost. It's a small slice in the bucket, but relative to this, it's still nothing to sneeze at. You're bringing in some real money. So in this scenario, this is how I'm going to actively get into a new stock position. If I'm nervous and I've owned the stock for a while, I might buy the put. If I just want to get in and bring in some premium, I buy the stock, sell the call. Then I say to myself, well, if I'm willing to buy more shares, let's sell a put down below and try to bring in some premium. And we'll continue to do this because we're still willing to buy another 100 shares of stock. All right, so basically I just covered everything that's on this slide. Understand the strategies and practices to trade tactically, using options to get in and out of the stock around a portfolio, using options when you're nervous to try to protect your portfolio by selling calls and using the premium to pay for the put, or buying the put outright. Now, the biggest thing about buying puts outright is if you find yourself doing it over and over again, maybe you should just sell the stock. Maybe you're not as bullish on the stock because the costs are high to insure stock relative to insuring your car. You know, stocks are a lot more volatile as far as the price is concerned as compared to your car price. So with that said, insurance is going to be more expensive on stocks. You're doing it as like this is the one time. Apple would have been a great example, right? You would have had to pay up for it, but when in hindsight, when we had the changing of the guard in the White House, you knew more than likely that there was going to be an issue with China. So maybe before the news hit, before the Liberation Day or the tariffs are being announced, you would buy some put on Apple. That would be one time where just buying a put outright would make a lot of sense. Now, a covered call or a collar, selling the call against it, and that might have helped too. But that is one time where you really have a lot of uncertainty as to what's going to happen. The day was announced, you knew when the day was, and buying a put on a stock like Apple, who has a lot of exposure to China, would have been a very solid trade in hindsight. But now the markets came back, received some good news. We're still in that flux period with Apple. They just announced earnings. So we'll look at a trade in Apple and we'll set up the collar and we'll do the trade, because I do think that that is an interesting time. Now, I'm going to emphasize this, and First Trade will back me up on this. None of this is meant to be a recommendation overall. We're just looking at, we don't know exactly what your portfolio is, what your risk reward profile is across the board. So, but we'll just look at an example, because I don't think you can get a better example of a time to think about protection than Apple, considering what is going on now. Stock has been resilient, fairly strong. What great American company, obviously. Okay, requires options knowledge. Your mindset is to manage risk and be the best predictor of profitability. Requires trading through periods of wins and losses, and realize that if the stock gets called away on a covered call, here's my best suggestion. Stop getting quotes on it. I've heard so many people say, like in our instance, we had the stock at 520, market went up to 540, right? That's where we would have needed to sell our stock or give up our stock. And they say, oh, I lost so much money on my covered call. And I'm like, why? Well, the stock went to 550. Yeah, but you own the stock and you sold it at 540. You didn't lose money on the covered call. You missed out on an opportunity, but you have to have that mindset that I'm just going to move on. I'm going to find another stock. I'm going to do that trade. And that is just so tough for beginning option traders. So I want to let you know that everybody has struggled with that scenario. Yeah, stop getting quotes on it. That's simple. And move on to your next stock. You did well. You did well, Pilgrim. You did just fine. Bought the stock at 520 and you sold it at 540. There's nothing wrong with that. All right. Vertical spreads are real interesting in this marketplace. I'm going to look at that a little bit going forward, and we're getting almost to the end here, so I want to go in and look. Well, I'm going to show a vertical spread just because of the volatility and the way the marketplace is. They're an extremely interesting strategy. You can use a spread to offset some of the costs of a put. And I just want to do all of this in Apple. So I want to get to my presentation on Apple. Here's my name. Here's my website is optionsplaybook.com, and that's my book, Options Playbook. The Options Play website you have access to, and this is where I want to go to right now and check out that. And my handle on x.com is @BrianOverby if you want to follow me and ask any questions through that platform. All right, so let's look at Apple. So in this instance, inside the Options Play platform, we pull up Apple. We see Apple is down today, so it's given a little bit more back. And once again, we have the concerns, but very interesting to see the support and resistance lines, to see that the market came all the way back up before Liberation Day, right? We had the stock trading at 258. This was Liberation Day, market went all the way back, and then it came almost all the way back. We didn't quite fill this gap right here back to the 225 level. Now we are here. You're scary. Yeah, right here is a little bit eerie. We're in the middle of this candle, broke below the 200, which was acting as a support level. Now that's a resistance level to the upside. And we have downside from 194. The next stopping point, you're talking at the bottom of this short channel around 170. All right, so how can we start by protecting? Let's go through the entire process. Right now, if I own 100 shares of Apple and I want to sell some call to try to offset some risk, what the recommended, based off of your settings, and you can do your income settings here, you can say I want to be aggressive, I want to be optimal, I want to be conservative, right? So aggressive means that I want more upside. I want to sell the 210 call as opposed to the 200 call. So I'm aggressive as far as where the marketplace is going. Conservative means that I'm at the 200. I'm not going to sell the 205. Optimal is probably right in the middle, right around the 205 strike. And that is exactly what it's recommending. I'm selling one of the May 30 205 strike calls going out about 23 days, and that's your desired time period. Giving yourself some upside, saying that if it does go back to that level, on the stock plus the premium, you can return about 25%. So over the next 30 days, if it got called away, once again, you can't be sad. You did all right on the position. Now, maybe you don't want to sell Apple. Maybe you had it for a long time. You don't want to sell it. But in general, what we're doing here is we're looking at a 25% annualized rate of return. This is the raw rate of return. If you were to be able to sell the stock through the call option over time. And then if you just look at the premium received above and beyond any dividends, that's called the raw rate of return, which is 1.43%. That means that we're selling this option contract for $2.74. If you click trade, you can see that $2.75 is, I guess that's where the midpoint is right now, 272, but we're dealing with markets that are moving at this point in time. $274, and that's about 1.4% of the underlying stock price. Solid dividend, right? That would be an amazing dividend for a company if they were paying it. The dividend yield actually is about 1%, $1 or about 0.5% per year in Apple. Saving up some cash actually, probably, overall. But if I'm looking at Apple, this is where it's at. That's selling the call. Now, if I want to sell a put, we usually recommend selling a little bit more premium because you don't want to miss out on an opportunity if the underlying stock moves away from you, right? So if you don't own the shares of stock, the strategy is going to be to look at selling a put option to buy the underlying stock at a specified price. So in this instance, they're showing the option grid, showing some of the recommendations. I would want to lean towards the 190 strike put. And I would, the 195 would be offered, but it's a little bit in the money. And these are the different strikes that are available. But now you're bringing in about 2.5%, not as much. That's the raw rate. Remember, that's the premium. That means that we're bringing $4.70 in on this, going out 23 days on that position. If we look on this put option, I always like to look at it as, what if I'm wrong? What if I don't get to buy the stock? I want to buy 300 shares of Apple, and I'm going to sell the put saying that if it comes down, I will buy more. Well, in this instance, if we're selling that cash secured put, recommend trying to bring in more as opposed to less. As to on the call side of things, we bring in less premium, but we're giving ourselves more upside of owning the stock. We got more potential capital gain on the underlying stock by selling something out of the money. Here, I'm worried that the stock might run against me, and I might not be able to get the opportunity to buy the stock that I'm trying. In this instance, I might even go out 40 days. So Apple's already announced earnings. We still got a lot of major news. But if I really want to buy the stock and I do the 90-day or the 190 June option, that's going out 44 days. Now we're talking about 4%. That's a decent rate of return on a stock over a year, let alone over 44 days. So out of these two option contracts in Apple right now, this is the one that I would lean on. And you can adjust all this. Once again, you got the short term. You can say, I want to do medium frame. I want to be optimal on this. And I can save that as the default for my trade. And then the next time I come back, when I go back and look at the options grid, this is the one that will have the check mark next to it that's going to match your income settings. Right? Fair enough. I'm not seeing a lot of questions out there. I must be doing a real good job of explaining. That's kind of meant as a joke. All right. So now let's go back and let's just trade in Apple. All right. We don't have a specific setting inside the Options Play platform for a collar strategy. But let's look at the collar strategy, and let's just go in, and I'm going to grab this vertical spread. Right now the market is bearish, so it defaults to bearish on our trade, and I'm going to modify this. We know on the upside we liked the 120 call, and we went out, let's go out about 30 days to try to stick with our forecast, and we're going to change this over to the call option. And we were looking at, I think, let's do the 215. No, let's do the 210. All right. So from here, that's 15 points. That's a solid move to the upside. Solid rate of return, solid raw rate of return. And then on the downside, we will buy something a little closer. Same expiration, we brought 219 in. Let's look at the 190, somewhere in that range. It's going to be a little bit expensive, so we're going to go 180, 180, 185, 180. Okay, that'll give us 15 points of downside with 15 points of upside. All right. So, that's what the issue was. So I'm like, God, that's really expensive. I didn't change the date. Like, why is that so expensive? All right, that makes a lot more sense. All right. 185. All right, I like this. Let's give ourselves 10 points of downside risk, and will give us 15 points of upside. And now, how am I getting that? From 195, and we can add stock. Let's add the stock. And then we'll look at this right here. And it's kind of hard to zoom in on this, but you own the stock. You have, I'll modify it again. Sell, buy. There we go. And you see that we now have limited and known upside on our 100 shares of stock. You might have already owned Apple, so you're only putting in the call option that we're selling and the put option that we're buying. But we're giving ourselves some upside run to the 210 level, which is, fairly recent highs, right? Right around here is where the 210 level is. 213 was the most recent high. And we're saying if we go up to 210, well, I'm okay with either giving up the stock or I'm going to do something to try to avoid it. But on the downside, I'm only going to have 10 points of risk from 195 on down to 185. So the total cost of the collar, I'm going to go modify this again and delete this, and we just hit trade, is $1.76. So $1.76 divided by, we'll call it 195. We're looking at less than 1% of capital that we have to put out for the underlying stock. We're going to protect ourselves from 180 on down. So we have 10 points plus the $1.76 equals that divided by 195. And we're talking about, so overall, over the next 30 days, our total risk would be 6% on Apple if we put this trade on right now. Gives you some protection to the downside, and you don't have to sell it if the market breaks down below the 185 level, which you're kind of seeing on the chart here. That's a little scary right in this level. If it gets to 185, there's a good chance the next stopping point is 175 or even down further. Or even down further. But what you're doing here is you're saying to yourself that I'm going to cap my downside at 6%. Now, here's another little tidbit. I don't have to exercise the put and sell the stock. If the stock goes all the way down to this 175 level, I can just sell the put. And I can buy back the call if I want to. So I can keep my stock, but I should have a decent amount of profit that should offset my loss on owning that 100 shares of stock. And the sooner the trade happens, well, I guess the sooner the better as far as the put is concerned, but you can still remain short the call too, and let that one ride to the end. So that's very plausible in order to do. So this is what a collar would look like on a short-term basis. Now, I also don't mind collars on longer-term basis. And Apple might be a situation. I don't like to buy a put outright if I'm just going to be nervous about Apple over the short term. But a collar is a little bit more interesting. You can go a little bit wider, give yourself a little bit more upside. So let's go back and let's keep these strikes. And I'm just going to go out quite a bit in time. So let's try to get through the summer, right? So we'll go out to August, the end of July, beginning of August, 100 days, a nice round number. And we'll put this all together. 15 points of upside, 10 points of downside. Now we have 100 days. We have, and if we click trade on this, now we're paying $1.28, and we're only going to play in Apple between 185 and 210. And that's it. If I do this trade, that would be my outlook. And then this is going to protect me for the next 100 days. And I do see a couple of questions. I see one from an anonymous attendee asking me a question, and I will address that. And all I'm trying to do is use a real life example, not meant to be a recommendation, but use a real life example to show how these strategies could be implemented. The only reason why I would not consider doing the selling of the put, anonymous attendee, and the question is, if you are not very sure on Apple's direction, why not simply sell puts? To me, you really have to want to buy Apple. And at this point in time, I don't want to buy additional shares of Apple. I don't mind dollar cost averaging. I have Apple inside my own portfolio, but I've had it for quite some time. I haven't bought shares of Apple in a long time. And I'd be more interested in this scenario to protect my current position than starting a new position. And I feel like most of the people would kind of be in that. Most people have Apple inside their portfolio. If you're talking about a different stock, a new stock that you want to try to build a position on, well, then I would consider selling that put option. All right. But if you want to, here's another way that we can go about it. And we looked at that. We clicked income. We say we don't have it. Going out 190 is the put that we're looking at. Looking at the June contract. This is the June contract. Bringing in $6.85, $685 per one contract, saying I want to buy the stock at 190. This is where our break even is at. Stock is here. We'd be buying the stock down at this level. Solid amount of premium for 44 days. I would like to see this above 4%. That would be ideal. I got to take a little sip again. That would be the ideal scenario. But I don't mind that, anonymous attendee. I don't mind any of this around Apple stock. I don't mind this at all. All right. Any stock that you would like me to look at, and then we'll call it a day here. We're almost at the 1 hour mark. But if somebody wants to put in a stock that you would like to either protect or hedge against, I'll be happy to address that. And while you're doing that, I want to show you one last trade here. If you just want to buy protection outright on Apple, as opposed to just buying the put, because you're paying up for protection in Apple right now, buying the put outright, well, you see here, the 190 strike put, if you were to buy it instead of selling it, it would cost you $885, $685 to protect your shares at 190 for the whole way down. So if I were thinking about buying protection on Apple, let's go back in and let's modify a trade again. Let's go back to the trade page. And I would just think about buying a put spread on Apple on my 100 shares of stock. I'm buying this put spread to protect my portfolio. And so if we stay with the 190 strike and we go out 30 days, we'll stick within, that's the May 30th, we go out to the June, 30 days, we're going to add a put leg here, keep the midpoint, we're going to be trading off the midpoint, 190. And let's say we're worried about, well, that level, you can kind of target it on the chart. You could either say 170, that's at the very bottom, 170. I think I'd feel pretty comfortable at the 175 level. And I think we can still get some premium for it. So let's go 190 here, $5. Let's go 75, see if we get, yeah, we do. So, and I'm June, I'm in the right expiration. I have this on, I'm getting 15 points. So this is a very, it's not giving you a very good options play score, but it's not saying that you own 100 shares of stock. They're saying this is a bear put spread. So if you're just getting bearish on Apple, the options play score isn't very good. But if you're using it as protection, it's a much different trade in this scenario here. Oops, got to change that up. I did buy and buy. This one needs to be the sell, and that will make our cost a lot better. And if you look at, well, and actually it doesn't mind that put trade either. But we're looking at it as protection. I own 100 shares of Apple. I can bring my cost down. If I were to buy the put outright, it would be $5.50. The midpoint for this spread is $3.50. That isn't that bad on a relative basis. I get protection from 190 down to 175. I look at the chart, that's where I'm a little bit nervous on it. From 170 on down, heck, I just want to get out almost, just from looking at the chart, not from saying that I don't want to own Apple for the next 15 years. But looking at the chart, this is an area of risk. If we come all the way down and we break below that, that's going to be a scary scenario as far as that's concerned. So this is an alternative that we didn't talk about in the slides, but this is an alternative to just buying the 190 put outright for $30. You actually do a put vertical spread on your 100 shares of stock that you own. All right, and I don't see any other questions. Is there any other stocks that you'd like to look at? I mean, another one that is interesting that a lot of people have shares of, once again in the Mag 7, is NVIDIA. NVIDIA is the same type of scenario. You're paying a little bit more for implied volatility, but we have that same scenario on the upside. You want to bring in some income. Stock is actually up today, so it's holding on to its own. 2.28%. We changed the settings. It's 40 days, saying the 130 strike, giving us an annualized rate of return, pulling down 20% on that. That's our, if we can do this each and every month, looking at a 20% rate of return based off of that. Let's see if we do, 23 days out, you're still looking at 2% from selling that call option against us. That's the 120 call. I'd want to do something around the 130, 140 level. So how do I use the chart here? This is when the first downturn, this is when DeepSeek came out, was right around 140. So if I was selling something, I would be targeting the 135, 140 level, something close to where the downturn started, because this was the DeepSeek news, came back up, and then we started getting into the tariff war stuff at the beginning of April. Stock has really struggled to try to come back, and that's where we are. Well, Caitlin, thank you so much. I really appreciate it. Sorry that I didn't quite start with the right screen being shown, but don't tease me about that. And I guess this will be it. After that nice comment that Kaylin gave me inside the Q&A box, I do appreciate it. We'll be back. We'll be doing this every other Wednesday. We'd love to come out and teach First Trade clients all about options and some of the tools inside the Options Play platform. A lot of synergies between the two companies. Love it dearly. I'll go back to my PowerPoint slide. My name's Brian Overby. X.com handle at Brian Overby. Optionsplay.com is what I'm showing you. My book is called Options Playbook, and the website is optionsplaybook.com. Thanks for coming in, and we'll see you soon inside the First Trade Zoom platform in a couple of weeks' time. Thanks for stopping in, everybody, and I hope that may all the option contracts that you buy finish in the money, and all the ones that you sell finish out.